Tesla gives itself more breathing room as it prepares to roll out its SUV, but will $640 million be enough to keep its financial house in order? I'm Emily Chang, and this is Bloomberg West. Coming up, Wall Street places bets on who's going to run Twitter. Could we get an answer next week? Plus, Apple may be closer to developing a self-driving car than expected. We will look at the Guardian report. And Comcast is said to be planning a new digital video service. All of that ahead on Bloomberg West. First, to our lead, Tesla raising money through a share offering, initially seeking to raise $500 million. Today, though, Tesla expanded that offering to raise $140 million more. So why is it raising this money? What's it going to spend it on? Why are investors so excited about this? I'm joined now by TrueCar Vice President of Industry Insights, Eric Lyman, and Jefferies analyst Dan Dolev. My guest host for the show, Rory, partner at Scale Venture Partners, with me here in the studio. But Dan, I want to start with you. Why are people so excited about this?
I think that the reason they're spending all this money, if you think about what they're spending it for growth of the Model 3, they're spending it for investments in the Model X, they're spending it on the Gigafactory. So people are seeing this and they're saying, hey, they see all this pent-up demand for their products and they're spending all this money. So that sends a very, very strong signal to the markets that a lot of growth is coming down the road. And that's why people are excited about this, in my view.
And yet, at the same time, Eric, on the earnings call, they made it clear they're not going to be able to make as many cars as they originally thought they were going to make this year. Isn't that cause for concern?
Well, the development of a vehicle can cost approximately about $1 billion and takes many, many years. So it's not just for the current environment that they're worried about. It's more the development of the Model 3 and any other future products that they have down the line. You need that capital well ahead of time in order to finance that development of the vehicle.
Eric is exactly right. I mean, when we first talked about this, it was why are they raising more? I mean, the question is they should raise all they can. I mean, this is a company valued at $30 billion, so they can issue equity relatively cheaply. They burn $200 million in operating losses and about $1 billion in capex a year. That's a lot of money, and they got $1 billion on the balance sheet, right? Would you buy a $70,000 car from a company that has only 1 year's cash? I don't think you would. So I think they're super smart to raise more money. They're a smart team. They know it's expensive. They know it's difficult. They know it always takes longer. So I'm amazed they're not raising more. I'm glad they got this done.
So, Dan, what about what Rory is saying here? That, there seem to be these suspicions that Tesla, doesn't have enough money and may not even be able to get to the end of the year. Is there anything to that?
No, I don't think so. And if you actually look at the cash flow and you look at some of the items in the cash flow, for example, some of the leasing cash flow is not counted as operating cash flow, even though it should be counted as operating cash flow. So I actually think that they're saying that they should be turning operating cash flow positive by the end of the year. I actually believe that's true, especially as they ramp up the Model X. Remember, they're going to get paid a lot more money once they deliver both Model S and Model X, and Model X production is ramping up very quickly in the fourth quarter. That should be able to take care of a lot of the cash flow issues. And as you move into 2016, obviously they're going to be selling thousands of Model X's and also thousands of Model S's. That should be a very good thing for their operating cash flow. Remember, sorry about
Eric,
that.
how much enthusiasm, Eric, is riding on the Model X itself? I mean, this is supposed to come out in September. What if it doesn't?
Well, we've already seen a delay of almost up to 2 years. I've heard of some owners that put their deposits down, $5,000 deposits nearly 2 years ago. So there's a lot of excitement, but I think there's also a lot of anticipation and expectation that this thing has to come in September. We've heard that the production has started, so by all accounts, we should see the Model X's rolling out en masse here by the end of the year.
Do you have a Tesla, Rory?
No, I do not. I am so not a car guy, but I have enormous admiration for what they've done. I mean, I think the issue is, we say we're certain it's going to come out in September. What they're attempting is so hard and hasn't been done in so many years. It's been such a long time since the last mass-market car company. All new set of technologies. And then to top that, we're going to build a new battery type as well. I mean, I didn't say these guys are out of money at the end of the year. I said they're thinking...
Others have said that.
Sorry, just want to be clear. The event, if I was running this company as the CFO, I'd want to make sure I had a fortress balance sheet, that I could last 5 years. That if, as your other guest said, production slips a year or even 2 years, you can ride it out. So this is what they're doing. They're financing for a 5-year play, and at this price, they should.
Dan, is this a fortress-looking like balance sheet at this point?
I mean, the balance sheet has issues as well, but again, I completely agree with the two other speakers. It's all about the 5-year play, and given we've done some proprietary survey work that shows just so much pent-up demand for their cars, so they don't have a demand issue, and as long as they don't have a demand issue, they will not have a balance sheet issue because they will start producing more cash flow as they sell more cars. So again, you're looking at it from today's perspective. There may be some doubt, but if you believe in the story and you believe in the demand, and our proprietary survey showed that there is a lot of pent-up demand for both models and the Model 3 as well, that should allow for a much stronger balance sheet as time goes by. Again, it's a long-term 5-year game. It's not a short-term game.
Eric, quickly, what do they spend this money on?
You've got to spend it on future development costs. I mean, Tesla really needs to become the true mass market brand. Just being a niche luxury electric automaker simply isn't going to pay the bills in the long run. They need to get mass market. They need that Model 3, potentially an even lower vehicle. There was actually a report earlier this week that indicated that the future of electric vehicles, the revolution could come from small, low-speed electric vehicles such as golf carts rather than a top-down sort of approach from a brand like Tesla. So you have to get that vehicle mass market.
Okay, Eric Lyman of TrueCar, Dan Dolev of Jefferies. Thank you both. Rory O'Driscoll of Scale Venture Partners, you're sticking with me. Now to Comcast, preparing a major new video platform that could rival Facebook and YouTube in online video. Here's what we know. The platform is currently called Watchable. Comcast is partnering with major digital publishers like Vouch, BuzzFeed, NBC Sports, and Awesomeness TV, according to Business Insider. As part of this partnership, the publishers have agreed to upload all unlicensed original video content to stream on demand, and the content will be ready to be bundled for Comcast's Xfinity set-top box owners at some point. Coming up, Wall Street reacts to rumors on the search for Twitter's next CEO. Still to come, Apple hits pause on the live TV service, delaying its rollout until next year. We'll explain why next. Twitter shares getting a slight push from reports a new CEO could be named as early as next week. According to a note from SunTrust, analyst Robert Peck, he expects the company to announce a tri-party leadership. Jack Dorsey as CEO, Adam Bain as COO and president, and Ev Williams with a stronger role on the board. Dorsey returned to the company as interim CEO last month after Dick Costolo resigned after a 5-year run. Here again with me, Rory O'Driscoll, founding partner at Scale Venture Partners, and our Bloomberg Twitter reporter, Sarah Fryer. So I think, first of all, we should pour a little bit of cold water on this report, because you and I, Sarah, have been talking to a lot of people, and there's no indication that this is happening next week. It's going to take a little bit longer than that.
It's definitely going to take a little, I mean,
or that's what's going to be announced, by the way.
This is a situation where you have a lot of people with very strong opinions about what is definitely going to happen.
Everyone thinks
they know. You know, we're hearing things on the very opposite of the same spectrum, saying, you know, they are interviewing outside candidates. They are going to take a few months to do this. Searches happen in months, not weeks. So it's just a matter of looking through the noise and saying, okay, here are the things we know. We know that Jack is running both companies right now. We know that he's making an impression at Twitter. He's making some changes internally and making them push forward on their product direction.
And he certainly cares.
And he certainly cares deeply about both companies. So whether that sets him up to be CEO, I'm sure it makes the board look at him a little bit more favorably.
Curious, Rory, how have you been watching this?
Sure. Well, the good thing,
as an objective investor,
I was going to say, you talked about a lot of people having opinions. I can start with, I have no information whatsoever, but I have been on a lot of boards and I've done a lot of CEO searches. It would make sense to wait a little, because
to wait a little to choose someone?
To wait a little to choose, because it's going to be an interesting and controversial decision. If you play back to when Dick stepped down, right? When a CEO steps down and you put in an interim, there's usually only 3 reasons to do it, right? The incumbent CEO wants to get out for some reason, personal, family reasons, whatsoever. Second, he's doing such an awful job that you've got an emergency. Or third, you want to try someone out. I got to believe, from all I understand, it's not the first. It doesn't appear to have been the second. Twitter is a $2 billion revenue profitable company, so you're left with the third. This is an interesting and probably controversial choice. Wouldn't you like to be able to say, hey, I did a try before I buy?
And yet the board comes out saying that so Jack already has a job, a full-time CEO job. At that point, who knows whether they knew that Square had filed to go public, but now we know that that is the case. And, you know, as we said, he cares deeply about both companies, and now he's kind of in a difficult position because the board has said this is a person who can't have 2 full-time jobs.
So they're looking for someone full-time, but you could also look at that strategically. Yes, if the board picked Jack, they'd have to walk back what they've said.
Exactly.
But you could look at that as something that the board was trying to do to nudge Jack to decide, is this what you're thinking too? And
let's talk about if this is even humanly possible, because the only example that we can come up with is that Steve Jobs ran both Pixar and Apple for a time when they were both public companies. Otherwise, there really isn't a similar comparison out there. Musk has Tesla and SpaceX. SpaceX is private. So in Walter Isaacson's biography of Steve Jobs, Steve talked a little bit about how difficult this was. He said, it was rough, really rough, the worst time in my life. I had a young family, I had Pixar, I would go to work at 7 a.m., I'd get back at 9, the kids would be in bed, I couldn't speak, I literally couldn't, I was so exhausted. I couldn't speak to Laureen, his wife. All I could do was watch a half hour of TV and vegetate. It got close to killing me. Do you think he should be allowed to do both jobs?
Allowed is one of those vague words. What law is going to stop him? Look, you can squint one way and say there's 2,000 CEOs, 4,000 public company CEOs today, 40,000 in the last 10 years, and only 2 have ever done it, Elon and Steve Jobs. If you're Jack Dorsey, you say, hey, I'd like to be like Elon and Steve Jobs. I'd like to play that game. I mean, it's a pretty interesting and challenging option for you. So he's going to be drawn to wanting to do it. The board's going to be drawn to want to have a clear and single CEO. And yeah, you're right. If they want him as a candidate, there might be a little dynamic going on here. He's trying to see can he get both. They're trying to see can they make him commit. Maybe they get an outside candidate that's better and the problem is solved.
The other complicating factor is that Chris Sacca, one of the biggest outside investors in Twitter, has come out saying that this is what should happen, which is what we saw in Bob Peck's note from SunTrust, who was basically repeating just what Sacca said he wanted, essentially, right?
Yeah, Sacca's been very vocal about what his opinions are. He thinks Jack can run both companies. He's showing that he can now, according to Chris. And he thinks by elevating Adam Bain,
aura around Twitter with Jack in charge, with the founder in charge.
The aura argument.
Well, that's important, isn't it?
It is.
This is what we talk about, founder CEOs, and they have a certain moral authority that...
Yes.
And Jack has always been very high level about his management style, and maybe that helps. And the fact that the companies are a block away from each other, that also helps. There's a lot...
You can rationalize anything if you want to do something.
Right.
That's exactly right.
What do you think should happen, Rory?
I have no idea. And, it's kind of back to the Sacca comment. You've no idea unless you're sitting there on the search committee where you look at 4 or 5 candidates, and every one of them will have pros and cons. There's a number of huge pros about Jack Dorsey. He's charismatic, he's a founder, he's got a product vision, but you run a process, you line up 3 or 4 candidates, and then you make a choice. The beauty of doing it the sensible way is that when you second guess, you can at least say, as a board member of a public company with a fair amount of liability, I did the best job I could, I interviewed, I ran a process, I picked the candidate. If Steve Jobs too shows up and is willing to do actually only one CEO job at a time, they'll probably take him.
Who do you think they're looking at in terms of outside candidates? Because they are, going through the Spencer Stewart playbook.
They're probably going through that thing you go through every time, which is you start off, you write the dream portfolio. I want someone who's done it before, been a founder, run a $2 billion public company, and is charismatic and a product guy. And by the way, has no other job. And then you look at real people, and then you make real trade-offs, and they'll make some compromises. And Napoleon used to say, "The graveyards are full of indispensable men." But that's quote.
We should all take Napoleon's advice. Okay.
Absolutely.
Well, Sarah and I are going to continue to talk to our sources.
Yes, we can.
And try to report this out, because we all want to know what's happening inside that search committee. Sarah Fryer, thank you so much for joining us. Rory, you're sticking with me. I want to talk about Apple now. The stock retreated slightly earlier, but closed higher today after Bloomberg News learned the company will delay its live TV plans until next year. Apple was aiming to unveil the service as early as next month at its annual product event in San Francisco, but sources say Apple doesn't have enough content or computer network capacity yet to do this right. One reason for the delay also, the price of the content. Just as Apple once convinced music labels to sell songs for as low as 99 cents, it now wants to offer a package of popular channels for just $40 a month, which is roughly half of the average cable bill in the United States. So, Rory, what do you think Apple's doing?
They're trying to persuade the...
Why isn't this happening?
Well,
can it happen?
All separate questions. What do I think Apple would like to do? They'd like to persuade large corporations like Comcast to sell them their content cheap so they can go on and build an attractive business that competes somewhere between Netflix and Comcast.
Wouldn't Apple like to buy everything on the cheap?
Yes, but that's exactly right, which is why it's hard. It's always hard to license a whole lot of content from 3 or 4 large media companies, especially when your business plan, simply put, is to take that content and your brand and go compete for their customers.
Okay, what about this? If Apple was able to accomplish this, would it be that revolutionary given the other offerings out there?
You're exactly
right. Would it be like the iPhone?
You're exactly right. I don't think it is,
smartphones?
which is why, I don't think this is what's moving the stock at all today. I think this is not going to be revolutionary. The iPhone was a new thing. It garnered dollars to Apple that weren't there before. What we're now talking about is a dogfight between Comcast, Netflix, Amazon, Google, all the cable companies, DirecTV, now you've got AT&T playing as well for a cable bill. And remember, the whole motive is to decrease the spend. We are fighting over a pie that could be shrinking, right? So I don't think it's a great and compelling business. I think great if Apple can do it. Why not get cheaper TV from someone? But I don't think it moves the Apple stock.
What about a self-driving car? The Guardian reporting that Apple is farther down the path than we might have thought in terms of developing its own self-driving car here in Silicon Valley, that they're looking for places to test drive it out in San Francisco.
Yes, that would be obviously totally revolutionary. And every negative comment I made about the impact of being the 17th cable company, TV provider, if you're the first person to provide a self-driving car, to state the least, you'll have interest. I mean, I just saw the article yesterday, was it 40,000 people in the US, some millions of people worldwide get killed. I would love a self-driving car. As we established earlier in this program, I am not a car guy. I don't own a Tesla. If a little machine could drive me from Apple or Google, can drive me to and from work, I'm in.
And guarantee your safety.
Well, the safety so far seems to have been pretty good. The funny thing is, the survey recently figured out that the Google car hasn't been in a lot of accidents, and when it has been an accident, it's been the other driver's fault. But the funny blog post said a lot of the time it's because the Google car drives so safely that the normal human driver never expects them to do things, and you end up...
I've talked to Sebastian Thrun,
Yes.
who created the self-driving
Yes.
car, about this very thing, and it's almost too safe. I actually rode in the self-driving car, Google's car, 5 years ago. It was a little bumpy, but supposedly it's made a lot of progress.
And are they close? Yeah, they might be close to product viability. The amount of complex legal issues that you're going to have to thread through before the complete self-driving car happens will be huge. But a lot of that technology creeps in. I think that's what happens.
Right.
If you look at the stuff that Mobileye makes, there's just a lot of different ways that technology comes into your car today.
All right, Rory O'Driscoll, Scale Venture Partners, you're sticking with me. Thanks so much. Coming up, the social network for lenders. We talked to the former PayPal employee who's turning your friends into your financial backers. It is time now for the Daily Bite, one number that tells a whole lot, and today's number is 2.76%. That's how much HTC shares rebounded after the company said it would cut 15% of its workforce. HTC also planning to reduce operating expenses by 35%. That's all after the smartphone maker revealed losses 5 times wider than expected in its quarterly earnings. HTC was once the top-selling smartphone brand in the United States, but the company is struggling to compete with low-cost phones from Huawei and Xiaomi. It's not the only company feeling the pain. Lenovo also plans to cut 3,200 non-manufacturing jobs as it integrates Motorola Mobility, which it bought from Google last year. Now, to the rise of alternative lending startups. There's the big peer-to-peer marketplace with Lending Club and Prosper. There's Max Levchin's credit card alternative for online shoppers, Affirm. But there's also this new class of startups using data science to parse credit risks. Vouch fits into this space. Founded by a team of ex-PayPal employees, it uses borrowers' social network to weigh their risk of default. CEO Yi Li joining me now to discuss, along with Rory O'Driscoll of Scale Venture Partners. So I find it incredible that someone could gauge my credit worthiness by looking at my Facebook or Twitter account. What is on there?
So I feel like I have to address this question all the time. As soon as people start talking about social lending, it's, oh, really? You're going to look at my tweets and you're going to make me a loan? Really? So that's not at all what Vouch does. Vouch is actually creating an entirely new and different social network, one that's based off of credit. So in the same way that you might connect with people online in a lightweight way and share photos with each other, you'll connect in a sort of heavier weight, more trustworthy way with people in a Vouch network and be able to get access to credit in a different way.
So what is it about? What is behind the explosion in alternative lending startups right now? Why is this happening?
Yeah, so you got to remember, we're still in this recovery mode from the Great Recession in 2008. Dodd-Frank, the legislation passed by Congress in 2010, really changed the landscape for how lending happens in the United States. A lot of banks and credit unions were pressed out of the subprime lending sector. And so what we find is this vacuum where literally hundreds of millions of Americans are actually in dire need of credit, but unable to access it through traditional mechanisms. And so that's really the vacuum that all of these startups are pouring into.
Rory, does the risk here worry you?
Well, the risk always worry you in lending. I mean, I think everything you said was true. I think that there has been a massive vacuum created by 08, 09 and Dodd-Frank. Some of it justifiable, some of it not. But the reality is in any lending business, you never know how you're doing 4 years out of 5, because when GDP is growing nicely, unemployment is low, everybody pays their loans back, and you think you're a genius. You grow revenues, you feel smart. And then in year 5, GDP takes a tumble, unemployment rises, and all those unsecured loans get write off. And it's kind of like you get all the bad news for 5 years packed into one. So I think one of the real challenges, and by the way, I really like your idea, and I'll talk about that in a second, but one of the challenges for alternative lending in general right now is you simply don't know how good these businesses are until you see a downturn.
So, how do you respond to that?
Yeah, so this is exactly why we founded the company and created it the way that we did. The alternative lending industry, I think, is absolutely ripe with all these new data players, and they're sort of taking these unproven approaches. Vouch is really based off of hundreds of years of track record of community banking, co-signing, microfinance lending, where as soon as you involve other people together into a financial product, you literally get amazing performance of the loan.
And chiming in on that,
look,
he's
I think there's a much longer debate to be had here, but we're going to have to leave it there. We're definitely going to keep our eye on you guys. I've talked to Max Levchin about this a lot as well. So Yi Lee of Vouch, thanks so much for joining us. Rory O'Driscoll, thanks so much for sharing your opinions today here on Bloomberg West. And thank you all for watching this edition of the show. It's Friday. Have a great weekend. We'll see you on Monday.